Good morning. Happy Friday. So, some interesting developments as this week has progressed through, of course. So, some of you may be incredibly elated with what's going on in the election cycle. Some might be terrified. The whole point behind any of that stuff, of course, is don't let politics infect the way you view investing. And unfortunately, the old wall narrative of nonstop stimulus seems to have driven equity prices to a point that are very heavily skewed. And so what I mean by that is every single day I get up and I look at price volume volatility of basically all the markets, including bonds, rates, currencies, you name it. And this morning, when doing the math, which is right here in my handy dandy notebook, I look at something called an asymmetry of a payout. And an asymmetry of a payout just gives me an indication of whether or not the upside or the downside is skewed for the particular day and whether or not it's getting deeper or better. And so the objective, of course, is that if the asymmetry of payouts is getting heavily skewed to the downside, we want to minimize equity exposure and in some cases increase our short positions. If the asymmetry of payouts are getting stronger, meaning more upside than downside, well then of course we want to increase our equity exposure and decrease or eliminate our short positions. And this morning, interestingly enough, we ended up with a 29-to-1 downside ratio. Now, just to give you a quick indication of what that means, that's incredibly epic. That we've never seen a degree of downside ratio like that this entire year, including prior to the February-March crash. Now, I'm not calling it a crash. That's not what this is about. What I'm suggesting is that the downside is much, much more probable at this stage than much, much more upside for a whole host of reasons. But predominantly, it has to do with the U.S. dollar. So this morning, again, the U.S. dollar is getting completely pounded. Now, it was heavily oversold yesterday on Thursday. And so I covered my short dollar positions because when something's oversold, the probability is that it reverses and bounces to the upside, which would have hurt profit in that dollar short. We sold our Swiss francs because, again, if the dollar goes up, Swiss francs, euro, a whole host of other currencies are going to go down. And so we wanted to get out of the way of that. Gold, incredibly overbought right now. Overbought, not oversold. Incredibly overbought. So I've taken down our gold position to a very, very small amount, booked profits there. And so the whole idea is to get protective because if the dollar reverses and bounces higher, which there's a very high probability it could, it's going to affect everything because there is a heavy inverse correlation to gold, the commodities index, to Bitcoin, to the S&P 500, to oil, you name it, everything. So next week could very well look like a quad 4 week with the dollar bouncing up and everything else getting hit, or it could move sideways. It just depends. We don't know. All I know is that the math is saying that we need to be very, very careful right now. So let me share with you a quick screen perspective here. And let me find, let's see what's happening here. Here we go. So this is a picture of the S&P 500 going all the way back to the end of August where we had a higher high. At that time it was an all-time high. And then here we are at the beginning mid-October. This is actually October 12th where we had a lower high. And here yesterday they put in a lower high again. Now this morning the math suggested that 35.19 was the high expected number on the S&P 500. Of course it can always go a little higher, but that in concert with the fact that the volatility measurement or the VIX had trend at 2606 and then it was tapping that level, what that did is it suggested that the S&P 500 has likely gotten very, very close to this topping point. And with a 29-to-1 more downside than upside ratio comparative to what we have seen historically in the past, then, well, basically what that does is it shifts how we want to adjust and how we want to view things. So bottom line is that we are in a situation with this market where this here is at a very critical junction. And because the downside is a good 6 to 10% below the current level. And again, I'm not suggesting that we're going to see a 10% drop from here. All I'm saying is that this drop here and this drop here came on the heels of characteristics that are exceedingly similar to what we're experiencing right now in volatility space of the VIX. VIX gets really low and then it shoots to the upside. VIX gets low and it shoots to the upside. So we have to remember that we had a low in VIX here, and then we had a higher low in VIX here, and now we've got another higher low probably based on the way that it's trading here. And so when you have higher lows in volatility and at the same time you have lower highs in the market or the indexes, on top of the fact that you have a dollar that's incredibly oversold down here, which also would be a higher low, testing this mathematical level based on price volume volatility, there's a high probability that the US dollar rallies. And if the dollar rallies and we've got higher lows in the VIX trading above trend, we've got lower highs in the commodity index, all it does is it points to a whole host of things that we want to be very, very, very careful about as we move forward. And so, as I said, we've taken equity exposure way down. I've taken gold exposure down. I've gotten out of the short dollar position. I've sold Swiss francs. For some whose risk measures allow, we've started to put a short position on for the S&P 500 because, again, the dollar is heavily oversold. The market itself is heavily overbought with a very heavy 29-to-1 downside ratio based on price, volume, and volatility. On top of all that, the CFTC futures are showing a net long position in the S&P 500, which means that's consensus. And we typically want to do the opposite of what consensus is saying or doing. And so that's why we want to just, at this juncture, be very, very careful. And again, Wall Street will point to all sorts of narratives in terms of why the market is or isn't doing good or poorly. Jobs numbers being perhaps better than expected today. But if you look at the pandemic unemployment claims, those continue to accelerate. That's a little concerning. Of course, the election is a wild card, apparently, at this point. And, markets certainly can have some volatility skewed into that. But if the market gets cranked next week, then, of course, CNBC, MSNBC, and all the news outlets are going to be pointing towards whatever the high-frequency data or the high-frequency narrative for the day happens to be. Probably something tied to the election, probably something tied to who knows what. But the reality is that none of that matters. It's all about the dollar. If the dollar goes up next week, then we're absolutely going to see a drop in equities, we're going to see a drop in gold, we're going to see a drop in Bitcoin, we're going to see a drop in commodities. And so that's why I've tightened up all the exposures to all that stuff. As I said, it's pretty rare that we get a 29-to-1 downside ratio like what we have this morning. Could it go higher? Yep, it absolutely could. Could that math just completely wash itself out? It could. I don't think it's likely. Very heavy implied volatility discounts in the options market have developed for the largest technology names, just suggesting that massive traders are heavily complacent. That's not normal. And usually, on the heels of that kind of a discount scenario being implied in the options market, we get a drop in price. So we're still quad 3. We still want to increase our net exposure to technology, utilities, real estate, commodities, gold, and treasuries, usually more focused at this point on treasury inflation protected securities, and then of course one of the other positions that we have to help focus on that opportunity. But we only do that at the bottoms of the price volume volatility mathematical range, and we're not there right now. So a little bit of time, a little bit of movement, a little bit of activity in the market, and we'll get there in no time at all. So anyway, quick update. If you have any questions, give me a call or an email. Direct line 608-354-1977. Email chris@carefrommywealth.com. And with that, I hope you have a beautiful weekend. Looks like an amazing weekend for weather. Hope you're able to get out and enjoy it. Thanks so much for letting me work for you. And again, God bless. Have a great day.